What if the next stock market crash isn't sudden? What if it's already starting quietly? Most market crashes don't begin with panic. They begin with signals. Small shifts. Subtle warnings. Changes most investors ignore until it's too late. In 2000, the signs were there. In 2008, the signs were there. In 2020, the warning signals were flashing again. And right now, some of those same patterns are beginning to appear. The real question isn't whether crashes happen. They always do. The real question is whether you see the warning signs early enough to prepare. One of the biggest red flags before every major correction has been extreme valuations. When stock prices rise much faster than company earnings, markets become stretched. At first, it feels normal. Optimism builds. Momentum accelerates. But when prices disconnect from fundamentals, the system becomes fragile. Fragile markets don't need a major shock. They just need pressure. Another signal investors often overlook is tightening liquidity. The stock market runs on liquidity. Cheap money fuels expansion. Easy credit supports growth. Low interest rates encourage risk-taking. But when rates rise aggressively, borrowing becomes expensive. Consumers slow down, businesses pull back, profit expectations shrink. Historically, periods of rapid monetary tightening have placed enormous stress on financial markets. Liquidity is like oxygen. When it starts disappearing, weakness begins to show. Stress inside the banking system is another warning sign that appears quietly before major downturns. Credit markets often weaken before stocks react. When banks reduce lending or tighten standards, economic momentum slows. Watch for rising default rates, cautious lending behavior, and increased financial instability. These signals don't always make headlines, but they matter. Excessive confidence can also become a danger signal. Late-stage bull markets are often fueled by euphoria. When risk feels low, leverage increases, speculation rises. FOMO takes over. Investors believe dips will always recover. History shows that the highest levels of confidence often occur right before major reversals, because markets tend to move opposite to extreme sentiment. Another subtle but powerful indicator is market breadth. When major indexes continue rising, but only a handful of mega-cap stocks are driving the gains, it signals weakness underneath the surface. A healthy market rises broadly. An unhealthy market rises narrowly. When participation shrinks, vulnerability increases. Now, this doesn't mean a crash happens tomorrow. No two crashes are identical. But patterns repeat. Overvaluation, liquidity tightening, credit stress, excess speculation, weak participation. When these conditions align, markets become sensitive. Crashes rarely begin because of obvious bad news. They begin because the system is overstretched. The trigger is often something unexpected. A policy mistake, geopolitical event, a corporate debt failure, a sudden economic contraction. But the trigger is rarely the true cause. The cause is structural fragility. The trigger simply exposes it. So what should investors do? Not panic? Preparation always beats prediction. Smart investors reduce excessive risk when warning signs build. They avoid unnecessary leverage. They diversify intelligently. They focus on quality. They watch liquidity conditions closely. They stay disciplined while others become emotional. The goal isn't fear, it's awareness. Because the investors who survive downturns aren't the fastest. They're the most prepared. If you want structured, calm market analysis without hype or fear-driven headlines, make sure you subscribe. This channel breaks down real financial risks, macro signals, and market structure so you can stay ahead of the curve. If this video helped you see the market more clearly, hit the like button. It helps this content reach more serious investors. And I want your opinion. Do you believe the next major crash is approaching? Or are these just normal market cycles? Comment below. I read every response. Markets reward preparation, not panic. And investors who understand risk always move first. I'll see you in the next video.